All right, thank you, Andrew. Well, time is 6:14, and let's look at your money this morning. As last week was a chaotic ride for the U.S. stock market. On Thursday and Friday, both the S&P 500 and Dow Jones Industrial Average suffered their largest two-day decline since March 2023. The tech-heavy Nasdaq fell even more, losing nearly 5% of its value over the 2 days. The Nasdaq is now down 10% from its recent all-time high set just 3 weeks ago. And financial advisor Mark Gravicheski is joining us now on Zoom to break down the numbers. Good morning, Mark.
Morning, Devin. Good to see you again. Happy Monday.
Yeah, so let's talk about what caused this big sell-off in the stock market on Thursday and Friday.
Well, before we get into that, Devin, very quickly, the U.S. stock market's set to open up a little over 2 hours away at 8:30. But looking at what we call some of the pre-market indicators, that sell-off is set to continue today. The Dow Jones Industrial Average set to open up 800 points lower. Earlier this morning, trading down over 8,000 points. S&P 500 set to lose almost 3% of its value, and the tech-heavy Nasdaq down 800 points, almost 5%. That means the Nasdaq will have lost roughly about 15% of its value over the past couple of weeks. But to get to that question of yours, look, we're right in the heart of the latest earnings season where companies are releasing their financial results for that April through June second quarter. And what we're seeing is literally one company after another lower their revenue and profit forecast for the second half of the year. Now, even before this latest earnings season, Devin, there was concern on the future outlook of the U.S. economy. Wall Street expected the economy to weaken, but there was considerable debate on just how much it would weaken. But now, over the past few weeks, you have all of these companies expressing serious doubts about the strength of the U.S. economy in that second half of the year.
So what exactly are these companies saying that's raising concerns over the health of the U.S. economy?
Yeah, one of the common themes we're hearing, Devin, from all these companies is a weakening of the American consumer. That all these years of high inflation, high interest rates are starting to take a visible toll on consumer spending. And remember, consumer spending drives over two-thirds of our nation's entire economic growth. Now, over the past few years, to help offset these prices, consumers have been forced to, pull money from their savings account, their retirement accounts, but they've also been forced to take on a record high amount of debt, especially credit card debt. And companies are feeling that pressure from consumers who are saying, look, I can't afford to keep up this level of spending, and I'm certainly not going to take on any more debt to do so.
Well, the Department of Labor also just releasing its monthly employment report for July, which showed the unemployment rate jumped to a 3-year high of 4.3%. So what's your take on this latest report on the labor market?
Yeah, that was a very disappointing employment report that was released Friday morning. But it also, kind of further stoked that Wall Street anxiety over the state of the U.S. economy. The unemployment rate, as you mentioned, jumped from 4.1% up to a 3-year high of 4.3%. Annual wage growth fell to a 3-year low. In July, just 114,000 new jobs were added. One of the lowest monthly gains in nearly 4 years. And this latest data on a weakening labor market, and you combine that with all of these comments being made about a weakening consumer, have heightened fears the economy will kind of dip back into a recession. And all that apprehension, all that anxiety is being reflected in a very volatile and choppy stock market.
All right, Mark Kravicheski with the Quad Cities Investment Group. Thank you so much for staying on top of it, and we'll see you next week.
Enjoy your week. Good to see you again.
You too.